Good morning and welcome to this Wednesday, July 28th, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, the earnings are coming in fast and furious. A lot of big companies reporting over the last couple of days. And I got to tell you one thing that's really consistent. These earnings are blowing out estimates. I mean, almost every company. And I'm not talking about beating by a penny or two. I mean, many of these companies are beating by 20, 30, 50% estimates. And, you wonder why the market's gone up so much and maybe why I feel the market's going to go up a lot more. But if you just consider where we are right now with interest rates being still near historic lows and this kind of earnings growth, I mean, it's unbelievable. And we're going to talk about earnings later in the show. But I mean, you've got Apple, $1.30 versus $1. Microsoft, $2.17 versus $1.90. Google, $27.26 earnings versus $19.89 expected. Visa, $1.49 versus $1.33. Starbucks, $1.01 versus 77 cents. I mean, the list just goes on and on. This morning, Shopify, $2.24. They were expecting 98 cents. I mean, these numbers are crazy. McDonald's, finally coming to life recently, $2.37 versus $2.12. How about Boeing? Boeing expected to earn 65, or actually expected to lose 65 cents. They posted a profit of 40 cents. As bad as the railroads have been, Norfolk Southern, $3.28 versus $2.94. Garmin, $1.68 versus $1.23. Teledyne, $4.61 versus $2.94. I mean, the list goes on and on. So, if you're at your next party and somebody's talking to you about PE ratios, just let them know, hey, earnings are going up. The E part of that PE ratio is changing. So yeah, PE ratios are high, but earnings are exploding. Price is going to go up with it. So I don't know. I'm honestly in shock looking at some of these earnings that are coming out. So I'm not at all surprised the market's been doing what it's doing, and I'm not surprised, in my opinion, that's going to continue to do it. We're going to have pullbacks along the way. Who knows what the Fed says later today? And actually, that's not a little thing. I do pay pretty close attention to what the Fed says because I do believe in the end, it's all about earnings and interest rates, earnings growth rates and interest rates, really. Anyhow, I can go on and on, but let's take a look at a couple of things here before we get going. So first thing I wanted to do is just take those of you who are new to Earnings Beats over to our website at earningsbeats.com. If you're not already a member of our free Earnings Beats Digest newsletter, if you're not already a subscriber, it's really simple. Just go to earningsbeats.com, type in your name there, your email address, hit that subscribe button. We'd love to have you. We publish it 3 times a week, Mondays, Wednesdays, and Fridays. Usually something to do with earnings, relative strength, something like that. And I think it'll help in your trading. No credit card required. You can unsubscribe at any time. We'd love to have you. All right. Let's take a look at what happened on Tuesday. It is Wednesday, right? All right. So on Tuesday, you can see the Dow Jones finished down 85 points. The S&P was down 21. NASDAQ, on a relative basis, hit pretty hard, down 180. But that's been the group that's been rallying pretty strongly of late, especially off of that May low. Really big move from 13,000 up to about 14,008. So a little bit of a pullback, not a big deal. We're still in a bigger pattern on the NASDAQ, an ascending triangle pattern. It measures to 16,000. So I think we're going to get there. And that doesn't mean we're going to get there this week, but we're going to get there. I think it'll be probably before the end of this year. I would not be surprised, probably in the fourth quarter, but I would be looking for 16,000. Mid caps down 15 points, small caps down 11 points. So on a relative basis, saw a little bit more selling in small caps and mid caps, and also in that tech-laden NASDAQ. But one thing that we did see is that the market came off of its lows. I mean, it was a pretty bad day yesterday. a lot of distribution. When I wrote my daily market report yesterday, I said this was one of the worst, well, definitely had been one of the worst days in terms of distribution since we bottomed back in May. You know, this May bottom here on the NASDAQ, this whole move to the upside, we had not seen the kind of red filled candlestick that we had yesterday, middle of the day, maybe even 2 o'clock, 2:30, but we rebounded, and you can see tails on all of these candlesticks. And these tails mean that we were down there on an intraday basis, but we came back up by the close. So we saw some selling, or excuse me, some buying late in the day, which I think is really good to see that later in the afternoon. Now we've got futures up this morning. Last time I looked, it was probably 10, 15 minutes ago, but Dow was up 13, S&P 4.5, NASDAQ up 60 though, getting a lift from some of these tech earnings. And we'll talk about those again in just a little bit. Continuing yesterday, utilities, big mover. Utilities have been pretty strong here in July. Don't get, too pessimistic because utilities are doing well. It's okay if utilities do well, especially considering they hadn't been doing well for quite a while. So money's rotating into that group. That's fine. I think the market looks good there. Communication services, which has been one of the strongest areas, we saw selling there. It's just rotation. Overall, I mean, I want to see utilities do well. I want to see utilities break out. I want to see all the groups break out to new highs. But it simply comes down to what leads. Where are your relative leaders? And that's where over time you want to see communication services, you want to see discretionary, you want to see technology, and at times financials and industrials, especially when the yield's rising. But all of these groups, I think, continue to look pretty solid. McDonald's yesterday was the best performer in the Dow Jones. You can see McDonald's having this huge move, big volume. For McDonald's to move from $226 to $246 in the course of about 7 trading days, that's pretty substantial. And that was heading into the earnings report. They came out, they blew away their numbers. The stock's down in pre-market. And that, in a nutshell, is how the stock market works: buy on rumor, sell on news. So you've got McDonald's, which reported $2.37 versus $2.12. Stock is down. Last time I looked, down about 1% pre-market. So down a couple bucks probably, somewhere around there. But pullback's going to be a buyable pullback in my estimation. You've got multiple tops coming across here in the upper 230s. Anything down around 238, 240, I think would be a really good entry point into McDonald's. And then there's UPS. I'm going to talk about this one a little bit more later. But UPS, with its earnings, gap down, went all the way back down to test the top of this gap support, and then bounced off of it, bounced about $5 off of it. So short term, I'm going to watch the top of this gap support. I'd like to see that hold 189, 190, right in that range. And then, of course, we have tops up around the 215 area. That's a trading range now in UPS. But it wasn't the worst performer in the S&P 500 yesterday. I think Lamb Weston was, LW. But UPS was one of the worst performers. And so I wanted to point out that chart. Okay, today is Fed Day. Not a whole lot going on in terms of economic reports, but at 2 o'clock this afternoon, the FOMC announcement will be out. And I'm not expecting anything different than what we've been hearing. I think the Fed doesn't see anything at this point to raise rates. I think they're going to continue to ignore inflation to some extent. I think they're going to recognize it, but I think they're going to continue to say it's transitory, meaning that they don't believe it's going to last a long period, that we'll eventually go back toward our target at 2%. And I agree with it. I think that this is a lot of the inflation that we're seeing is simply a supply chain disruption. There was no demand for a while during the pandemic. So many factories shut down. Supply was at a standstill. Manufacturing was mostly at a standstill. And now all of a sudden we're coming out of this pandemic and demand is everywhere. No matter what, whether it's to improve your house, whether it's to buy a car, go out and buy a house, take a trip, everybody wants to do something and they want to spend money. And unfortunately, the other side of the equation, the supply side, was shut down for a while. So what it's doing is it's driving prices up. It's economics 101, supply and demand. You got a ton of demand, pent up demand, and because of the supply chain disruption, we don't have supply. So everybody's trying to quickly get back up to speed, and that creates higher prices. So I agree with the Fed. I think we are going through a short-term period of inflation. It's high. It's scary. The headlines, you get a lot of fear mongers that'll use those headlines to scare you into thinking that we're heading into a period of hyperinflation. I don't see it. And I'll be honest, I don't see it in the market. Forget about what the Fed's saying. I listen to what Wall Street's saying too. I'm looking at the charts. I'm just not seeing it. The 10-year Treasury yield is probably one of the biggest clues. I mean, when you're looking at a 10-year Treasury yield throughout this entire period of these high hyperinflation type numbers, look at what the yield's doing. How does the Fed combat high inflation? By raising rates. Well, the Treasury market's not looking like they're expecting any kind of rate hikes. So I think this is one of the big signals telling me to not worry about inflation. Everybody's got to do their own thing. I could be wrong. The Fed could be wrong. Everyone could be wrong. You know, maybe we're going to head into the most inflation we've ever seen in our lifetime. Who knows? I don't believe it though. All right, let's move on to talking technically. Let's talk a little bit about the S&P 500 here, because I did like that reversal. You have a negative divergence here. So you've got higher prices, you've got a lower PPO, although I'm not as stuck on a negative divergence here on the S&P, because between these two highs, we have a 50-day test. What I'm normally looking for is something like this, where you're going higher, you keep trying to move higher and higher, and the PPO rolls over, and then you go back to the 50-day, get back close to the PPO center line, you reset, and then you start moving again. In this case, we already went back to the 50-day between these two highs. So technically, yes, that is a negative divergence. Anytime you have higher prices and you have a lower PPO, it's a negative divergence. Well, guess what? This, if we compare 4,400, look where we were here. Prices are higher. 4,400 prices back here we're under 3,600. Look at where the PPO was. 2 versus under 1. Technically, that's a negative divergence, right? Higher price, lower PPO. So we could do this forever. I've pulled up the NASDAQ from near 2000 on like a weekly chart. And the PPO went up so high in 2000. We're 21 years later and we've never taken it out. Have we had a negative divergence for 21 years? I don't think so. But textbook definition we have. So it's all in how you interpret these signals. A lower PPO simply tells you that the moving averages, the two moving averages that you're using, which the default's 12 and 26-day EMA on a daily chart, the two moving averages are closer together when the PPO is lower. So as prices are going higher, your moving averages are getting closer. I mean, it's useful information, but it's not the information. It's not the only thing that we're going to look at. So you got to understand a little bit about how momentum works and so forth. Again, this one doesn't bother me as much as, say, the NASDAQ, which I never went back down to the 50-day moving average. Went below the 20, but never got quite down to that 50-day moving average. And I think if you look at something like the XLK, you only go down to the 20-day. Now, to me, this is more of a negative divergence that I would be concerned with than what we saw on the S&P 500. But really, negative divergences, I like to see them across the board. I like to see negative divergences everywhere popping up and reversing candles. Yesterday, it looked like we were failing to hold the breakout on the XLK. It also looked like we might threaten a 20-day EMA. That type of reversal with the negative divergence would have had me much more concerned than getting the reversal that we did in the afternoon. So hopefully that makes some sense to you all. All right, let's move on. I want to look at the S&P 500 again. I'm going to look at an hourly chart. And normally what I look for is when we're going up and the PPO is going up, I normally look for this test of the 20 hour and to be successful and then move back up. So this was a little confusing on an hourly chart to me because we didn't hold the 20. We continued to go right down through it like it wasn't even there. Got down into this gap support area and then reversed right back up through the 20 like it wasn't even there. So normally that's a pretty key moving average. I mean, if we go back here, see how we trend above the 20, we get down to the 20, we bounce here, we get down to the 20, we bounce. Then we have a negative divergence on this high, and then we go back down. We reset, and then we start it all over again. This didn't really work out quite that way. Now the PPO was getting a little stretched, so probably needed to unwind a little bit. We got that. But I think looking at the hourly chart, the two other charts I wanted to show you. First one is small caps. So small caps, you can see, first of all, downtrend for sure. If we go back, look at the small caps versus the large caps. So here's the S&P 500, higher highs. We go back to the small caps, lower highs, completely different animal. So we started strengthening just, I don't know, a week or so ago, a little over a week ago, and we've pulled back, and we've now had 3 pullbacks, actually 4 pullbacks, where we've come down and tested about 1305 to 1310. And we bounced off of that number again yesterday at the into the close. So I think small caps have a pretty important short-term support right around 1305. I don't want to lose that in the near term. Same goes for the mid caps. Mid caps have been doing a little bit better, but you can see these pullbacks right here, 2640, right here, 2640. And then yesterday, the low got down 2643 before we reversed. Double top up at 2685, 2690. So we need to get back up, make that breakout, but watch the support level. If small caps and mid caps fall back, we're not going to get that real big push that we're looking for from all the areas in the market. So something to keep in mind as we go forward here. All right. What next? Let's take a look at, I wanted to show you the UPS chart. All right, so here's the price chart for last year. Down here on the bottom, what you'll see is accumulation distribution and on balance volume. Now, normally, when you're looking at these, I mean, normally, we're going down, kind of going down on the OBV, and then the AD line goes up, and then the OBV line goes up. See how they're kind of going together? And then we both of them roll over. Well, look what's happened over the last 6 weeks. We just set a new on balance volume low on UPS with yesterday's action. And we just set a new AD line high with yesterday's action. So what's the difference? If you're not familiar with these two, this is, yesterday kind of underscores the big difference between these two indicators. Personally, I like the AD line over on balance volume, and I'll tell you why. On balance volume only looks at, okay, yesterday we closed up at 210. Today we closed at 195. So we're going to take all of this volume and make it negative. We're subtracting all of the volume, 100% of it, even though there was some buying in there that we had a tail off of that. And the other thing is you can't trade between the 210 and the 195 level. If it closed at 210, I mean, ignoring after hours and pre-market hours. But from the close yesterday or day before yesterday to the open yesterday, this stock changed by $12 and you couldn't trade it. So the picture changed. This wasn't distribution. This was market makers looking at the imbalance between buy and sell orders and opening the stock some new place. Now, my argument is, okay, now you and I and everybody else in the market has a new price to trade United Parcel Service. Do we want to buy it or do we want to sell it at this new price? So I don't think you really know whether you've got accumulation or distribution until you see what happens after the opening bell. That's what the AD line tracks. It only tracks what happens during the day. It ignores the gap down. Now, maybe you disagree with that. Maybe you think, hey, we need to pay attention to the gap down. For me, I think there's a lot of manipulation that takes place in the market. And United Parcel, UPS, they reported earnings. They beat estimates. I think it was the number of deliveries or something that were lower than expected. So, there was a lot of hype about that. The stock gaps down. But after selling off from 198 all the way down to 190, we hit a key support area, and then buyers came in. And so we finished way off the low on very heavy volume. So the on balance volume to me just completely ignores the fact that we had buyers coming back in and that we closed closer to the high of the day than we did the low of the day. And that's where the AD line comes in. What the AD line does is it uses where you close relative to the high and the low as a multiplier of the volume. So it's not, if you finish in the upper half or you finish, in the upper quarter of the candle, it's not like you add up all the volume. You're taking a percentage of it. So the fact that we closed pretty close to the middle, maybe slightly higher, you're taking a small percentage multiplier times this volume, and then you're adding it. I think that's fascinating. I mean, the more I think about it, I think that, AD line, of course, we've talked about it quite a bit over the last year and a half because of the pandemic. It was probably one of the best signals in the market last year. And I still use it as a secondary indicator. I don't buy and sell stocks based on the AD line. But if I've got a stock that I like that's sideways consolidating and the AD line's going up, that's, to me, gives me a little bit more comfort that what I believe is happening, which is sideways consolidation, maybe weak hands selling, strong hands buying, and we're going to break out. The AD line, to me, confirms that. So anyhow, it'll be interesting to see how UPS plays out here. AD line's rising. The on balance volume is declining, setting a new multi-month low. AD line setting, what is this? Maybe a 10-month new 10-month high. So let's keep an eye on UPS and see. But I wanted to go through that because I do think I know I get a lot of questions from time to time relating to those two indicators and why I use the AD line and why I don't use the OBV. And that's the reason. I don't like the OBV because it ignores everything happening during the day. You could be down 1 penny. You could imagine UPS at 210, opening at 190 and coming up and closing at 209.95. Huge hollow candle, massive volume. No way you could convince me that's selling. And yet the OBV would still look the same as it does here because it doesn't care where it closes. If you're down 1 penny, I don't care where you opened. If you close down 1 penny, all the volume's a negative. To me, that's just not, common sense tells me that's not right. It's not going to give me the signal that I want. So that's why, personally, I don't like the OBV. Now, I do like the OBV to confirm what I'm seeing on the AD line. I like it when the two go together. I think they do kind of give you a little bit more warm and fuzzy as far as whether stock's being accumulated, whether it's being sold off. So I like them going together. But if they diverge, I'm going to stick with the AD line. All right. Another question that's come up about the China sell-off here the last couple of days. You can see here the Shanghai big sell-off, 35.75 down to 33.75. We're talking about, I don't know, 6-7% just the last 3 days. And so the question was, what impact is this going to have on the U.S.? And I can tell you, I almost never pay attention to what's going on in China. And I know that sounds kind of weird. And when I say that, I mean, there are a lot of companies do business in China. Obviously, I'm interested in what kind of business they're doing. But I'm talking about the market, the Shanghai Stock Exchange Composite Index. I don't really follow it in terms of trying to figure out what's going to happen in the U.S. because the correlation between our two countries over the years, our indices, the correlation is not strong at all. So I got a chart here. This is a 20-year weekly chart, S&P 500 on the top, and the correlation between the S&P and the Shanghai on the bottom. Now, anything above the zero line means there's positive correlation. Anything below the zero line, negative. If you get to a -1, completely inverse correlation. They're going opposite. If you get to a +1, then they're going together. Now, when I look at this over the last 20 years, I would say that there's more positive correlation than there is negative or inverse correlation. But I just see a lot of choppiness. I don't see these two countries going hand in hand. I just don't. And when you look at another country like the DAX, you're going to see a big difference. So here I've got the correlation between the S&P and the DAX. Do you see the difference? The S&P 500 and the German DAX go hand in hand most of the time. And then there are just a few exceptions where we move into negative territory. We've been positive almost exclusively for 20 years in terms of correlation. Now go back and look at China. So if the two indices don't go together, as much as you might think that they would, then should I be worried when the China market goes down? I know that there's a lot of inverse correlation between the two countries. I'm not. So when I look at this chart and I see China getting hit, maybe you're going to see it in headlines, but the charts tell me don't worry about it. Worry much more about what's going on in Germany than what's going on in China. So anyway, wanted to mention that. So let's talk a little bit about earnings, because man, we have a lot of earnings reports coming out, and I'm talking big earnings reports. So we got Apple. Apple, as I mentioned, I mentioned some of these at the top of the hour. So Apple, easy beat, down about 1% in pre-market. So I'm going to go over here. Let's do the pre-market. I'm just going to rifle off some of these real quick so we can see where they are. But Apple, easy beat, and the stock's down 1%. Look at the buy on rumor. So now the news is out. We're down $1.70. Anybody buying to get in for earnings are shaking their head because they're looking at the same, they had a big beat, 30% above estimates. Why is it down? It's the way the market works. I can tell you for the most part whether or not a company is going to report good numbers. What I can't tell you is whether the stock's going to go up or down at the open. Now, I like a stock like Apple or McDonald's or Starbucks, companies that are doing well heading into their earnings. They report great numbers and they pull back. I look at those pullbacks as opportunities. So I wouldn't hesitate to buy these stocks, especially on 20-day tests or price support, that sort of thing. Microsoft, easy beat on the bottom line. Stock's up $3. And they were down, I want to say they were down about $8 after hours when I first saw it. So they've come back pretty nicely. Great cloud numbers for Microsoft. How about Google? Google up $92, 3.5% today, over 2,700, almost $100 on Google. So nice response there. Then you got Visa. Visa had a big beat, $1.49 versus $1.33. Stock down $1.75, but it's been going up. Chances are pullback's going to be buyable. Starbucks down $3.53. Horrible, right? Well, the stock was $109 a month ago. Just went up to 126. So 122, yeah, a little bit of a pullback. We might go back down to this 20-day, but I'd be a buyer of Starbucks on the 20-day. AMD beats 63 cents versus 54, and we're up $2.73 here, back to 93 and change. So we're getting close to a breakout level, not quite there. Enphase Energy in the renewable energy space, 53 cents versus 42 cents, stock down $5. It made a big move. I would watch down here probably at around 155, 160. I'd like to see this area hold. So we're still well above that. Now, one company that looked horrible going into its earnings, Teladoc. Teladoc down $16 with earnings. Look at this. The market's been doing great. Teladoc has been moving down, and look at the volume that's been associated with this push to the downside. So the fact that it's back down to these recent lows, actually, this is a good one to pull up. I would be watching on Teladoc the low close of 132.71. So if we open at 135 and then intraday go down and take out this low and then come back up above that 132 level, you could go long. And if I did that, whatever that low is that goes below 130, that's my stop. So let's say it goes down to 125. Panic sets in, 125. It comes back up above 132. If I traded it at 132, I'd set my stop below the low. Just thinking that what we have is a false breakdown. If we open above 132.71, now if we open below 132.71, because market makers know where that candle body low was, 132.71. If we open below that, I think that's a signal the stock's going down. If we open above that, we may go down, but we also may have a false breakdown. So that's where I'd be looking for that reversal. All right, Shopify. Let's see if it's time yet. Oh, okay, the market is just opening. So, okay, and we just opened at 134.78 on Teladoc. So this is one that as a short-term day trader, I'd be looking at Teladoc for a possible trade on a reversal. Anyway, Shopify up $23, but hasn't broken out. It made the breakout before earnings came out. So I think we're going to probably just trade in this range. I'm going to say 1,500 to about 1,650. And we're right in the middle of that right now. I don't know which way Shopify goes, but I can tell you this, their numbers were outstanding. So if it pulls back, I'd be very tempted to buy into Shopify. 20-day test, or if it breaks below the 20 and does get back down to 1,400, remember we got the Fed coming out later today. Who knows what's going to happen? We could see some extreme volatility, but I would use weakness as an opportunity to get into some of these stocks. So Shopify. Let's do three more, and these will be the three you must see. So I want to look at McDonald's. Let's see where McDonald's is. Again, 237 versus 212 on earnings. Stock gaps down. I think it's an opportunity to get in. I would be buying and accumulating down to about that 238 level. I think McDonald's goes higher. Boeing. Let's see what Boeing's doing. So easy beat. Expected loss of 65 cents, and they came in with 40 cents. Now, this one's a little bit trickier because there's so many levels to try to take out. First piece of good news is we're back above the 20-day. Let's hold that. So if I'm looking at this and I'm saying, okay, Boeing is starting an uptrend, if that's true, the 20-day EMA should hold on the next pullback. So if I was looking at Boeing, I would try to get it on a pullback down below 230, and then I'd have a tight closing stop below that 20-day EMA. The last one, I was looking for a breakout in Humana, but I think, and they did beat, but the beat was minor. And yeah, it's getting hit pretty hard. Look at this. I was waiting for the catalyst to get us this breakout above this 470, 472 area. We were there. We needed earnings to do it. Earnings came in better than expected, 689 versus 686. But you can see Humana down 5.7%. I wouldn't be surprised to see this one reverse back to the upside later today. We'll see. One last one I'll give you. I wanted to see what Garmin was doing. GRMN. So this is the four you must see. Garmin easy beat $168 versus $123. Stock's not breaking out, but it's already baked in. Nice AD line, beautiful uptrend. So good news was already priced into the stock. We got the good news. I'd be a buyer on the 20-day if we see it. All right, quick update on the market, and then we'll wrap this thing up. Appreciate everybody tuning in. We've got the Dow Jones down 2, S&P up 5, NASDAQ showing the leadership today. Remember, it was showing relative weakness yesterday. Now it's showing relative strength, up 63 points, or about 0.4%. Small caps, mid caps doing well also, and the VIX declining down here. So all in all, pretty decent start to the day. We'll see whether or not we can strengthen as we go further out. All right, everybody have a great day. I will be back for a recorded version of Trading Places Live over at Stock Charts TV, which you can access by clicking on that link right there tomorrow morning at 9 a.m. Eastern. But I'll be back to do that recorded version tomorrow at 9. So hopefully see everyone there. Until then, have a great day. Watch for the Fed. Let's see what happens this afternoon. Could be an increase in volatility after that 2 o'clock announcement. Although, again, I'm expecting the Fed to remain all right. So with that, everybody, hopefully see you tomorrow. Take care. Happy trading.